Welcome to OpalesqueTV. Today I'm in London together with Adrian Elwood. He runs the Clerkenwell Matterhorn Fund. This is a fund of European real estate securities and it's run in a long-short format. Since inception the fund has had an impressive track record. But before we talk about the fund, let's talk about the man. Adrian, please tell us more about your background and your history.
I started working in 1980 and qualified. My first role was as a chartered accountant. I moved into the city in 1984 and through a series of accidents I ended up following the real estate sector and it's been my career ever since. More recently I worked as the head of research in the real estate investment banking division of Hypo. It provided a number of extremely useful lessons to me. First of all, watching the credit process in action in an extremely well-run bank, watching the credit office, the lending officers try to make loans and the credit committee try to stop them making loans, so that we ended up writing extremely good book of business, which actually ended up coming through the depression rather well. The other thing it taught me was that I'd always had a perspective as an equity investor, and when I went to work for a bank, I realised that actually, as far as they were concerned, all the equity was a buffer to prevent them from making losses. And you see the investment process through completely different eyes. Doesn't normally matter, but when companies go into distress, then the bank's only interested in getting its money back, and you realise that the equity can disappear pretty fast because nobody's there to protect it. After Hypo, I went to work for Henderson Global Investors. I spent 6 years there. This is really the key part of my career and certainly the most enjoyable until I set up my own business. I worked on the listed real estate investment team. I was responsible for running a couple of dedicated relative return funds which grew pretty large during the boom years. So I had the experience of running them in the good times and the bad times. What was one of the biggest real estate investment cycles we've ever seen. And it's really there that I learnt how to manage money, how to run a portfolio, and it's where my approach to investing in listed securities really evolved and informs quite a lot of what I do now. I left Henderson in 2010 with the intention of starting my own absolute return rather than relative return fund. So I started the management company in 2010 and spent a couple of years getting the fund off the ground, and we finally launched in September 2012. One of the advantages of listed real estate is it gives investors access to pools of very high quality property in a corporate form. And there is the prospectus, if you like, of the REIT managers, the global REIT management community, is that it's real estate in a listed format, so you get the ability to pick sectors, to move between sectors, and to get exposure to the underlying real estate, and generally speaking, the better quality real estate, which individual investors can't get access to. But to do that in a listed format so that you've got the liquidity of the stock market to move between investments. And I am a great believer in that, but I don't entirely buy into the ethos that listed real estate is just property in a listed format. Because I take the view that they're listed companies that invest in real estate. So I look at them from the perspective of a stock market investor investing in companies which invest in real estate. And that gives me, I think, a little bit of a different perspective to the group of REIT managers that I used to be a part of. One of the problems that the REIT managers have is that as their portfolios get bigger, you soon get scale disbenefits, and it becomes increasingly difficult to make those switches. So one of the things I wanted to do was run a relatively small pool of money. I was responsible for billions of euros worth of securities at Henderson. My ambition in Clerkenwell is only to run £50 million. And that will give me the ability to move around between large caps and small caps. One of the reasons that's important to me is because I look at the sector from a number of different perspectives. First of all, I look down on it from the top, and I take the view that you have to have a view of the macro. Then you can choose subsets of the market, London offices, European retail, and you can move between those. But the bigger the company, the more it's a beta play on the underlying asset class. The smaller the company, the more it's a play on the skills of the management, and the more it's dependent on the deal making and the structure of the company. And my experience over my career is that the long-term winners are the small, medium-sized companies which grow through bull markets to become quite large companies. Those are where the best returns are. So I wanted to put myself in a situation where I could make the most of those small cap and mid cap ideas, as well as being able to make thematic choices. Another thing I wanted to be able to do was to make my own sector call. As a relative return manager, particularly in these days, you have to be pretty much fully invested. You can have views on the cycle, but you can move from slightly more aggressive to slightly less aggressive. You can have a little bit more cash or a little bit less cash. But broadly speaking, you're fully invested, and your own investors are the people who make the decision as to whether to be in or out of the sector. Whereas I wanted to be able to take that call myself. And so I needed to be in an environment where I have a mandate which allows me to do that. What I mean by absolute return, really, in a very cyclical sector, is a fund which is broadly long biased, so which takes advantage of the big, long cyclical upturns in the sector, which allows me to disinvest from the sector when I think we're entering a down phase, to protect capital by not being invested, and then to take advantage of falling markets with short positions where I think this is appropriate. So the idea really is to make the most of the bull market, to defend capital to the best possible extent in a bear market, and then be better placed at the start of the next bull market to start again from a higher position, as it were, the higher starting point, than a relative return manager who's simply ridden the cycle all the way up and all the way back down again. So I'm running the two things in parallel, which are the core portfolio of small mid-cap stocks held for the medium term, and a trading overlay of broadly large caps, which give me market exposure and sector exposure, but where I want to be able to unwind the positions very quickly if broader stock market conditions turn against me.
Well, Adrian, this is a very unique and special way to run real estate assets, and it seems to work. Your track record is really impressive. So please walk me through your performance and how have you done since inception?
So I started the fund in September 2012, and in the period up to the end of January 2016, I was up 91%, which is an annualized 20.3% return. So 2015 was a very interesting year. The fund was up 22.8% compared to the EPRA benchmark in sterling of 12.8% and the FTSE, which was actually down 5% on the year. The European REITs really kicked off very strongly at the beginning of 2015. I think they were up 9% in January alone on the back of the ECB's QE programme. And then as the year progressed, they essentially gave that return back again and then finished strongly into the end of the year. My portfolio was pretty much uncorrelated with that. I started the year quite slowly, and my broadly small mid-cap selections did very well on individual stock performance. One thing I did do last year was take off all my big cap bets towards the end of the year. because I was getting increasingly uncomfortable with the amount of volatility in the stock market, which seemed to me to be creating volatility in the stocks, which I just didn't need and wasn't creating any return. So the individual stocks did quite well and were not particularly exposed to the broader volatility in the stock market, which probably explains why I did quite well at the back end of the year.
So Adrian, in real estate, we're now in January 2016. Where are we now in the real estate cycle according to your analysis, and where do we go from here?
That's a really good question, and one I get asked more and more. You know, you've had a really good run, isn't it the top of the cycle? Isn't it too late? And I think the way to think about that is really to go back to where this cycle started and what's different about this cycle compared to previous real estate cycles. I mean, the first thing is that we're in a completely uncharted territory. And we started in 2009, after the great financial crash, with a massive QE program turning financial markets. Now, in the run-up to that time, I spent quite a lot of my own time trying to work out what the authorities would do to stem the crisis. And one of the things I look back on was how the 1970s property crisis in the UK, secondary banking crisis in the UK, was resolved. And of course, the main component was an injection of liquidity into the market. But another very important component was the way the authorities stopped the dumping of property. Because just like in 2008, 2009, in the 70s, we were in a downward spiral where property values were falling on themselves, if you like, because there were so many forced sellers. And in the 70s, the Bank of England, through the leading liquidator of the time, a guy called Kenneth Cork, they essentially got the banks together, they stopped the selling of property, and they put the banks and the receivers into the situation where people had to come and bid them for property rather than them dumping property. And that process really helped to turn the market. And I was wondering how that would be repeated, because it seemed to me that was essential. And the answer was Ben Bernanke's QE program. Because so much has been written about what it was and how it worked and whether it's been a good thing or a bad thing. But one of the things that's not been really talked about is how important real estate was to the collateral of the banking system. And that one of the things QE did was start to solidify the value of that collateral. Once you'd started injecting liquidity into the banks, they could start to relax and not dump assets, and they could create structures which would allow them to disgorge their property slowly rather than quickly. Perfect example of this is the NAMA resolution program that was put in place in Ireland. As we all know, assets were transferred at pretty discounted prices, or loans were transferred at pretty discounted prices into NAMA. But the point about NAMA was that it had a 10-year mandate, and that took all the pressure off the selling. Many people would approach them and demand that they sell assets, but they resisted all of that until they got to the point where the market wanted to buy the assets, and they've slowly but surely sold assets into that rising market. Here we are, 2016, and NAMA is more or less done. It's a corks down, essentially. It's almost an exact rerun of what was done in the 1970s. It's a really, really important part of the turnaround. And one of the ways it worked was by forcing interest rates down to such low levels that people were really incentivized to buy real estate. I remember many people back in 2008, 2009 said it was impossible for the real estate market to recover without the availability of debt, and my view was that was irrelevant. What we needed was equity, and by effectively removing the interest rate on people's bank deposits, it encouraged more and more people to take money out of the bank and buy property and start to turn the market. If you remember, in 2009, you could buy prime assets in central London on 8% yields, and the reason people didn't was because they weren't entirely sure that the tenants were going to pay the rent. As soon as they started to be confident about that, the buying process started. Here we are, 2016, those assets now change hands at 4% yields or less, and the rents have gone up too. So they've been fantastic investments, but that process has been driven by QE, and it has allowed the banks to disgorge their distressed loans into rising prices and rebuild their capital. Very, very important part of the process. That's the big macro cycle. And against the background of that, what you might call a normal property cycle has been playing out. I mean, normal property cycles essentially have two broad types. They have ones which are created out of the ruins of a development boom, where considerable amounts of vacant space have to be let into the early stage of an economic cycle, and that tends to make property a late cycle performer. Or you have essentially balance sheet recessions, where the distress is in the balance sheets of property companies, not in the rental side of the business, and that's what we've had this time around. Very little surplus stock available, so as economies have started to recover, what little space has been absorbed quite quickly. Those who've been able to develop have been able to develop into quite tight markets, and we've had quite strong rental growth relatively early in the economic cycle. So this time round, real estate's been an early cycle performer. So you've had those, you've had one big super cycle, but within that, the two components of the QE cycle and the normal property cycle playing out together. So, and of course at different rates in different countries. London was the first to emerge. Some parts of Europe still haven't in a way, but Ireland has, Spain has, Sweden has. All these countries have been running at different paces, but the driving forces have all been broadly the same. So the question is, where are we now? And it would be true to say that at the end of last year, the property market was starting to get quite nervous that the next move in rates, because of what the Fed was planning on doing, was likely to be up, and that would mean that property yields would start to go up again, and that would effectively choke off the cycle. But actually, what we've seen in the last few months is that bond yields have gone even lower. So this puts us at a very, very difficult juncture, really, because if you think about property from the perspective of property entrepreneurs, property investors, very low yields, the yields where they are at the moment, they're very uncomfortable with. If you think about property yields from the perspective of where bond yields are at the moment, they're not so expensive. So we're very much at a crossroads, and the property market senses that. So looking into the future, it looks as though interest rates and bond yields are going to stay lower for quite some time. So in a way, that takes the pressure off the yield side of the equation. In economic cycle terms, I would argue that we are in London maybe late cycle, in some countries still relatively early cycle, but we're broadly mid-cycle. What would choke off the real estate cycle, the underlying fundamental real estate cycle, is an economic downturn which started to choke off tenant demand, leaving developments exposed and driving rents down. That would be the classic ending of the cycle. But in the current environment of low growth, low interest rates, low inflation, It doesn't look as if that's on the horizon just yet. I mean, obviously, if you look at stock markets, they're extremely volatile at the moment, and that would undoubtedly be, in the end, bad for property, just the same as it would be bad for everybody. So the components of the investment market have evolved through the cycle. You know, we started off with high net worth individuals, sovereign wealth funds, all sorts of people like that, and over time they have dropped away in the same way that they've dropped away from various other defensive assets. One effectively new group that is getting stronger is the institutions. In a very low interest environment, those who've got flexibility of the mandate are looking for ways of adding extra yield on top of very low return bond portfolios. Real estate has started to rebuild itself as an asset class, having been abandoned by institutions in the past. Some of the really big global funds like the Australian Super and the various Canadian state pension funds, you know, they got real estate allocations of 10–12%, but almost nobody else has got to that level. Some still have almost nothing. And I think the longer interest rates stay where they are, the more pressure there is going to be on those institutions to progressively rebuild their real estate weightings. I don't think these people are price insensitive at all, but once these investment trends have started, they tend to be, you know, multi-year, if not multi-decade, in timing, just in the same way that the cult of the equity was, and indeed the switch to bonds has been. So I think that support for the market is going to remain, going to be pretty constant, I think. I think we're still supported by the low interest rate environment, and it looks as if that's going to continue to be in place for some time to come. But I'm very conscious that the broader investment climate is very difficult at the moment. So I have de-risked the fund to a great extent. My strategy when I de-risk is to take off my big trading positions and my large cap stocks first, then to sell some of the medium-sized names, but to try to defend a long-term portfolio, core portfolio, for as long as possible. And that's where I am at the moment. I took off the big trading positions in August, and apart from a few attempts to trade rallies along the way, I've got no exposure to those companies. So the portfolio at the moment is really a collection of special situations and particular themes. And one theme I've been keen on really from the start of the fund, and I still am, is mid-priced residential development land in the UK, and I've got a couple of holdings which are exposed to that, and I still think there's considerable scope for future value to come from them. I also think there's more to come from regional recovery in the UK as the British recovery spreads out from London. And after that, I've got a number of special situation and individual stock holdings which I think are isolated from the broader market trend. An example would be a company called Harworth Group. This is it used to be called UK Coal, and it owned the assets of the British deep coal mining business. I've been tracking it for 10 years. I thought it had fallen into receivership and was lost to the stock market, but it suddenly came back to the market a year ago in a heavily discounted IPO. The asset value of the shares at the time was 9p. The company came back to the market at 7.25. I felt that the published asset value was understating the potential in the business quite considerably. I bought as many shares as I could in the IPO, bought more in the aftermarket up to about 8, and I'm now sitting on a position which trades at about 12, with more to go as the underlying value of the business comes through. These situations don't come along very often, but you have to be in a position where you can take advantage of them. One company I have recently increased my position in is a Swedish investor in semi-social housing, because Sweden has its 1960s Million Homes programme. These are quite heavily regulated rental properties. They were well built, being Swedish. They need upgrading, but the waiting list for these houses, these flats, is somewhere between 10 and 15 years. You simply can't get one for love nor money. And whilst the rents are regulated, it's possible to improve them by upgrading the properties. And in an uncertain world, this seems to me one of the most defensive investment classes you can possibly find, and the shares are trading at a discount to asset value. I think it's a very, very attractive situation indeed. So I'm looking for those kind of opportunities, very much stock-specific opportunities, whilst trying to avoid the big macro ebb and flow at the moment. I'm looking for short opportunities. I mean, the real estate cycle is quite developed, so we've got over-ambitious companies starting to emerge, and I've got a growing list of potential short candidates. I actually have one short on at the moment because I think there is a bubble in high-priced central London residential which is in the process of bursting. And I think flat values and underlying land values will have to readjust, and I'm positioned for that. It's the only short position in the portfolio at the moment. And then I'm looking for opportunity. The fund is structured as a Maltese professional investor fund, PIF, which is designed to give the manager a considerable amount of freedom. I come from an institutional background, and I'm more comfortable with the UCITS type rules. So we've imposed on the fund the classic 5 and 40 and 10% rule. In terms of gearing, I've also adopted the UCITS style basic rules of 2 times gross. I'm also limiting myself to 1.5 times net, because I take the view, whilst you can gear, doesn't mean you have to, and I'm not comfortable running a portfolio that is more highly levered than that, and my strategy doesn't really require it. So I've self-imposed essentially those rules on the fund.
Adrian, I understand risk control is a really strong focus in your daily job of managing the fund, but please share with us more details about your risk management procedures.
As I've already mentioned, the first level of defence is to unwind the large cap trading portfolio. Effectively take off any gearing that's in the portfolio. So in practice that means going from a maximum of 120% to maybe 80%. And the second level of defence would be to sell some of the mid-cap holdings. And I tend to take that in stages, so that the more dramatic the impact of stock market conditions, the more defensive I start to move the portfolio. But I'm trying to defend the core portfolio to the greatest possible extent, because I don't want to interfere with medium long-term stock selections. So I'm very loss intolerant of the trading portfolio, whereas I'm prepared to ride through market volatility on the small and mid-cap core portfolio. In terms of diversification, the 5 and 40 rule and 10% rule mean that I can't over-concentrate the portfolio. I have to be quite careful in making sure that the 10% holdings within the 5 and 40 section are my best ideas, and I tend to move them up into that group and be quite disciplined about taking them back down again when I think that the opportunity has passed. The portfolio tends to have in the region of 20 stocks. which is sufficiently concentrated to maximise the amount of alpha, but on the other hand has some diversification, to the extent that you can get diversification in a single sector portfolio. In terms of short exposure, I haven't to date taken trading positions to defend the portfolio in falling markets. I've tended to think that we're still in a broad bull market in the sector, so having taken off my long positions, my next decision is when to put those holdings back on again, rather than to make trading shorts or defensive shorts to protect the portfolio in the first wave of a sell-off. When the sector moves more clearly into a bear market in the future, then I shall be looking to take more aggressive short positions. In the meanwhile, what I'm looking for is fundamental short positions, and as I said before, I've got one exposure at the moment based around my bear case on high-end central London residential, and I'm looking for other stocks around the universe of companies which have become, in a way, too confident and too highly rated as the bull market has developed. I had no stocks at all in that potential list a year ago, and now I've got quite a few, so maybe telling us something about the state of the sector. I run the fund on an absolute return basis. Now that means a lot of different things to a lot of different people. But in the cyclical sector that is real estate, what it means to me is taking the maximum advantage of the bull market and then defending capital to the best of my abilities in a bear market. What it doesn't mean to me is running a market neutral strategy.
Adrian, tell us more about the current investor base of the fund.
Obviously, I'm a significant investor in the fund. We started it with friends and family support, and we've been joined by some high net worth individuals along the way. Of course, now with a 3-year track record, some other institutions and family offices are starting to look at us. So what we're trying to do is build the assets under management towards 50 million, which is really the ceiling of what the strategy can sustain without diluting performance.